Hi folks, Chuck Gibson from Financial Perspectives with May 2018's Charts on the Move. Well, it may not be apparent, each month I try and have a theme or key takeaway or two from each video. This month I'm going to drift all over the place, presenting a bunch of charts that really don't have a thread or common theme. Instead, they're ones that I find interesting or kick the old brain into high gear. So let's get started. My first chart is a 3-year look at the 3 major global equity markets. The top blue line is a measure of the US stock market. The middle green line is Europe, the Far East, Australia, Asia. And the bottom red line is the emerging markets. What's interesting to note is that global stock markets all peaked on the same day. It goes to show global diversification turned out to be of no value, which is what you tend to see during declines. All markets are interconnected. The other thing that grabbed my attention was the position of where price of each of the indexes sit as compared to the February low. The US has rallied and made back a bit more than 50% of the initial decline. Europe sits just a hair above February's lows, while the emerging markets, well, they're below. The US markets, while not fully recovered, are showing relative strength to the rest of the developed world. In my next 3 charts, I'll try and see if I can find a possible reason why. Much of Europe's near-term problems are centered directly on what's going on in Italy. I won't spend the time here, but if you aren't aware, it's all about the government and debt. Nothing really new, but rather raising its ugly head once again. The next chart is a look at what happened overnight to Italy's bond yield. It went from under 0.5% to over 2.5%. Well, 2.5% is still a reasonable rate for a 2-year bond. The magnitude of that change, almost 500% increase overnight, was enormous and restoked investors' fear regarding the viability of the EU and the euro. Of course, when investors get nervous, it's not just about bonds. It's about all assets, and stocks are not immune either. My next chart is that of the US ETF that tracks the Italy Stock Exchange. I think the chart speaks for itself as this huge topping pattern that has developed and broken decisively below support points to potentially much lower prices ahead. When you throw in Brexit, Greece, and what's going on in Spain, Europe has some huge problems. Those that I've spoken to individually about major risks, Europe is the one that I see could be the catalyst to eventually drive stocks worldwide into a significant correction. Moving over to the possible reasons why of the emerging market weakness is directly related to the dollar. In the next chart of the dollar, which is one I showed last month, you can see it has rallied since breaking out of that falling wedge and has hit its second upside target. Closing this week with a bearish gravestone doji tells me this rally is likely done short term, but where it goes next will tell whether foreign stockholders are in for more pain. There is currently more than $12 trillion in emerging market debt denominated in US dollars. Yes, that's with a T, trillion. When the dollar rises, the debtors' payments rise as they convert their payments into dollars to pay the debt holder. Even though they may have a fixed payment, it increases if the dollar rises, putting pressure on businesses and governments making those payments. The higher the dollar rises, the higher the risk of default on these loans. That's the risk debtors had to accept to have access to the U.S. capital markets, and it's coming back to bite them in the butt. Just as importantly, as you can see in my next chart, there's more than $300 billion denominated debt coming due in the next 18 months. With the dollar romping higher, refinancing this debt will likely cost a whole lot more, thereby reducing their chances of finding a lender here in the US or elsewhere, creating a potential for a liquidity crisis. Virtually every past major stock market decline was triggered due to the lack of liquidity. And add fuel to this fire, this is all happening while the Fed is removing liquidity from the system, so this has the potential to be very problematic for the markets. Moving back here to the US, the next chart of the S&P 500 shows how the index is clearly stuck within this box, created by the upper boundary of its January high and the bottom by its February low. For those new viewers, this is a perfect example of consolidation. Consolidations are periods of the investment resting and then gathering energy for its next move. But the direction of that next move is never known with certainty, so investors are best served by being patient and waiting for the market to dictate to tell the direction, rather than trying to predict and guess. I have mentioned since bottoming in February, but want to remind everyone again that we will likely not move out of this consolidation for months. The next chart helps to illustrate the reason for that warning, as it shows how long recent past double-digit declines have taken to resolve. Markets don't repeat, but they do rhyme, which is why I believe we have many more months of uncertainty and choppiness ahead. Most U.S. stock sectors look like the broader index and are stuck in a box, but interestingly, small caps are not. In my next chart, you can see how the small caps actually initially moved in lockstep with the rest of the market, as they too peaked in January and bottomed in February. But that's where the similarity ends, as they have gone on to break out to new all-time highs, showing relative strength against the broader market. While small cap stocks have been stronger than the broader market, surprisingly, they have not been the best performing. What has blown small caps out of the water is, as you can see in my next chart, stocks that have the greatest number of outstanding shares being shorted. Anyone that's been on the right side of a short squeeze knows exactly how this could be leading the market. What's much harder to understand is why there are so many short sellers getting pinched at this point in time. My final chart that is performance related is a look at year-to-date performance across the futures market. Notice 12 of the top 13 best performers are commodities, with lumber leading, gaining more than 36% already this year. The only non-commodity is the VIX, which is a measurement of fear in the market. This kind of makes sense considering the market went through a double-digit decline and is yet to get back to even. Looking at the worst performers, 8 of the bottom 10 were commodities, the exceptions being the Canadian dollar and the US 30-year Treasury bond. What I find most interesting looking across the entirety of this chart is how bifurcated the commodity market is. It's sending signals both warning of inflation and deflation at the same time. When commodities move, they all tend to move together as a group. Clearly, this is not the case now. My next couple of charts are bullish tailwinds that could help resolve the current US stock market consolidation to the upside. The first shows that more than 80% of the S&P 500 companies that have reported so far have beaten the estimate provided earlier this year. This is the highest beat percentage level on record. The second of the two bullish fundamental charts show that the corporate buybacks are set to exceed their highest level ever. This, of course, is bullish for stock prices because after the buybacks are complete, fewer shares of those companies are on the open market, thereby pushing prices higher due to the decline in supply. The next chart helps to illustrate how fast the world is changing. Netflix has now topped Walt Disney Company in market value, challenging the film, TV, and theme park giant for the title of most valuable media company in the world. What's most astonishing is that Netflix didn't launch its website and put its first set of videos up for rent until 1998. Disney, on the other hand, has had more than 95 years to build their business up to the level of Netflix. My final chart is an eye-opening example of why what Wall Street teaches you can, at times, be wrong. We're taught that diversification is the key to investment success. The first chart I presented, if you remember in the video, illustrated how spreading your risk across global markets did nothing to reduce the risk during the decline. Well, if diversifying didn't help to reduce risk when the market pulls back, surely it must have helped when it's moving up higher, right? My next chart helps to illustrate that this was not the case. As you can see, over the past 10 years, as European equities have been an albatross to a US-only stock portfolio. Don't get me wrong, I'm not condoning diversification, but rather trying to point out that nothing works at all times, even something as good as diversification. This is why, as investors, you need a way to capitalize on the current market, not the markets of the past. With that, I'm going to call it a wrap. Sorry for the helter-skelter randomness to this month's charts, but maybe you found them as interesting as I did. Until next month, as always, I appreciate your time and your attention. Hope you found this video informative and helpful. If you have any special requests for the next installment or comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening, and until next month, this has been Chuck Gibson from Financial Perspectives with May 2018's Charts on the Move.